time now for our regular strategy session. In the hot seat today is Alwyn van der Merwe, Director of Investments at Sanlam Private Investments. Thanks so much, Alwyn, for joining us this afternoon. Let's get straight into it, because as part of the new normal here, when it comes to global economic growth, China is increasingly being looked at as the future growth engine. It's a territory that certainly cannot be ignored at this stage of the game. Your assessment of the Chinese landscape and the economic landscape specifically right now?
Yes, if we look at the short-term view, I think everybody was concerned about a potential bubble, particularly in the property market, and specifically for the residential property market in the first-tier cities. And we know that the Chinese government interfered there to try and protect the economy against that particular bubble. My view is that, given the numbers that we've seen being released over the last week, is that I think it's quite a controlled slowdown that we see in the economy. If you go back a week ago, the full year growth numbers were released for the year to the end of June, and the full year number came out at 9.5 versus the expectations of 9.3, so it was slightly better than what the market expected. But if you analyze that a bit more closely, I think what I particularly thought was good about the numbers is that if you look at the first half of this year, the momentum is starting to slow down, which is, I think, a positive, but it is certainly not a so-called soft patch or a hard landing that many people forecasted. That is the first thing. And secondly, also, and it's also got longer term implications, if you look at the pattern or the major drivers of the growth, we've seen that consumer expenditure has contributed about 47% of the growth, where fixed capital formation contributed 53%, and that was really the driving engine in the past. But you can see that the impact of consumer spending is starting to improve, and that is exactly what the authorities would like to achieve. So the other factor, of course, that is very important in China in the short term is just the high inflation rate. The inflation rate is over 5%, which is high in Chinese terms, and another big concern for the government. And as a result of that, we've seen that government again interfered. Bank reserve requirements went up steeply, and we've also seen interest rate hikes in the economy. However, we think that the inflation numbers are likely to peak in the next month or so, and in all likelihood, we've probably seen the last hike in interest rates there.
So where there's been concern, because it's that inflation number, Alwyn, that's really triggered much of the concern, in that it could well spur on further tightening. Where that is the case, you're saying that the risk that tightening will need to happen a little bit more aggressively moving forward has pretty much been minimized at this stage.
I think so. If you analyze that number, you must understand that food prices are quite important in their CPI basket. And food prices, as we know, is not necessarily, higher food prices is not necessarily a function of higher demand. It is a function of shortage of supply. So by hiking interest rates, I don't think you're necessarily going to bring the food prices down. And of course, the authorities recognize that and realize that. So based on that, we feel that we've probably seen the end of the tightening cycle in China, and therefore it should be positive for growth going forward.
And a positive for that consumer that you touched on as well, where we traditionally know that, the Chinese consumer has been more of a saver as opposed to a spender. Lending to that theme, we've also got urbanization happening at a pretty fast pace, and, that with this need to move the story more so to internal demand. What are you making of the stride we're seeing in that regard?
Yes, if we can just unpack some of those numbers. Over the last 10 years, 200 million people urbanized in China, and the forecasts or projections are that we will probably see another 200 million being urbanized over the next 10 years. So it's a structural trend that we don't see an end to. Of course, what will happen is that many of those people will not go to the cities, but they will take the cities to the consumer. So, and if you look at the earning pattern within China, you will see that the big growth rate in earnings, all of that happened within the urban areas and not in the rural areas. So if you assume that urbanization is going to continue, then I suppose it's quite logical to assume that the spending power of the Chinese consumer will increase going forward. Now remember that the Chinese economy depended a lot on European consumers and the US consumers to consume the production out of China. And that, of course, led to a more cyclical economy. Our view is that as consumption expenditure increases in China, it will lead to lesser dependence on those first world economies and should also reduce the cyclicality within the Chinese economy, which is positive from a secular or longer term perspective.
So let's take a look now at what this means specifically for our markets, because it's an impact that now extends beyond just the African commodity story.
Yes, I think from a equity perspective, there are probably two themes. The one is the one that you've just touched on, commodities, of course, because remember, despite the fact that hopefully we will see the consumer expanding or increasing its role in as a contributor to economic growth, the fixed capital formation theme is not going to go away overnight. And if you think that we're going to have a controlled slowdown or only a soft landing, given the fact that China consumes about 40% of many commodities in the world, I think it should also support continued demand from the Chinese economy, and therefore should support commodity prices. So that is certainly still a theme on the go, and I don't think that is going to go away soon. The other theme, of course, is that, and it's also an objective in the 12 5-year growth plan of the Chinese authorities, is to increase the disposable income of the Chinese consumer, and hopefully you will get a strong growth in consumption expenditure. And of course, that means that certain consumer companies should benefit from that.
So let's get straight into it then, Alwyn, because from a South African perspective, it's the investors' a major question. How do they, as an investor, tap into that growth potential pretty directly? Because there was a point where it was South African banking shares that were in vogue if you wanted exposure to that proverbial Chinese dragon.
Yeah. Look, it is possible for South African investors to get direct exposure to the Chinese economy. There is a so-called equity exchange or equity exchange traded note that has been launched recently, so you can directly tap into that. But there are also direct equities, South African listed equities that our consumers can get exposure to. The one that stands out on the consumer side, of course, is Richemont. If you actually look at the top brands in China, you will see that BMW is the number one recognized brand in China, and the second biggest recognized brand in China is Cartier, which sits squarely within the Richemont stable. And we've also seen that if you look at the Richemont sales numbers, that over the last few years, they sell just as many goods in Asia than in Europe. And remember, the roots of the company lies in Europe. So I think longer term, Richemont should certainly benefit from their footprint in the region, and South Africans can get direct exposure in our own market.
In terms of that value proposition of Richemont, before we move on, I mean, it's got, it's really struggling to balance between the growth it's seeing and maintaining exclusivity of its brands itself. With that growth, is that a possible headwind that Richemont faces at this stage?
It is indeed. If you speak to the Richemont officials, they will say, they can certainly grow faster from a financial or operational perspective. But, given the exclusivity of the brands, if they grow too fast, they will lose that exclusivity. So I guess if you look at the Richemont proposition in the East, it is one of controlled growth, if I may use that word. Compared to, let's say, a consumer company like Starbucks, if you question their officials, ask them how fast they can grow, they just say faster. But that's not an exclusive product. Nevertheless, if you can grow at 15%, which is more, I think a pretty fast growth rate, even in South African standards, I think that is pretty good for Richemont. If you look at the valuation of Richemont, though, it's no longer a cheap company, but if you take a longer term view, relative to its other luxury goods peers globally, it probably trades slap bang in the middle of the pack. So I guess if you believe that the China story is going to come through longer term, you would like to accumulate the share on some weakness.
So let's take a look at exposure now via the commodity space, because just yesterday we had Kumba Iron Ore out with its earnings report for the first half and really impressing the markets, but a lot of concern as to whether the iron ore prices that we're seeing right now and providing bulk of the impetus to those results are sustainable moving forward, because it's largely based on the kind of demand we're seeing come through from a player like China.
Yeah, I think your question is a very valid one, and I think it also starts at the right point. You know, whenever we analyze these companies, the starting point is where are those resource prices or the commodity prices, where are they priced at the moment? And if you look at the Economist Dollar Metal Index in real terms, and you take the graph back to 1960, you will certainly see that commodity prices are generally trading at very elevated levels. So a lot of the good news are arguably priced into the commodity prices themselves. However, if you look at the valuation of the commodity shares like Kumba, Anglo American, Billiton, if you look at the valuation of those shares, you will see that based on consensus earnings expectations over the next year or two, that those shares are trading at pretty attractive valuations. Both Billiton and Anglo trade at forward multiples of below 7 times. So in short, I think what I'm saying is that the commodity shares don't believe that the commodity prices are sustainable, and that is exactly why you've asked that question. So the next question to answer, I suppose, is, okay, so what is priced in? And we think that even if commodity prices come down in general, and it's a general, I mean, we're talking about a basket of commodities here, if they decline by about 15% or so, the company should still produce pretty good earnings in this kind of environment. So you can see that unlike 2007, 2008, many of these commodity shares are far more cautiously priced and have priced in a slowdown in the commodity prices themselves.
So taking cognizance of the risk that does present itself, let's move on to a company like Naspers, because it's tapped into the social media space, and that via its the holding that it has in Tencent China. Concern among fund managers and traders have been that internet growth in markets like China have possibly matured at this stage. What's your view on a player like Naspers and the kind of presence it is set to hold moving forward within China?
Look, firstly, if you look at Tencent's footprint, they've got an absolutely phenomenal footprint, and they've got the inside lane in terms of subscribers. Depending on how you calculate that, you get different numbers, but let's use a conservative number of about 600 million subscribers. So the numbers are just mind-boggling. That is the first point to make. Secondly, if you analyze the last results of Tencent, you would see that just more than 50% of the revenue came from gaming revenue. Now, that in itself is a phenomenal number, but I don't think that particular number is necessarily sustainable. I think they had a few titles that were particularly popular, but that doesn't mean to say that that will necessarily be the case going forward. However, when you look at the revenue, I think the one area where they can certainly enhance the revenue growth is in increased advertising growth, given that footprint. And again, from a secular or longer term perspective, I think that is a theme that must still play itself out. So although we're not going to see the same growth rates compared to the last 3 years or so, I think that the company will still continue to grow in South African terms at a pretty rapid rate, but the growth rate will slow down. I think the other thing that you've also got to recognize is that the company will continue to invest, and that might mean that in the short term, over the next year or so, that the margins that they've incurred, that those margins will come under pressure. For instance, they have given an indication that the one area where they do see pressure is, of course, on wage increases, and that the wages will probably increase between 20 and 30%. Now, we think that is a shorter term phenomenon, and it's just part of running a business and gearing the business up for the next era of growth. So from a longer term perspective, we're not that concerned, but we know that whole industry, that the pricing levels are pretty elevated, and if you get a slowdown that disappoint the market, that is a risk. So it is not, I don't think it's a risk-free share. given the difficulty to forecast the earnings going forward. But I think it's still a longer-term story that hasn't played itself out.
Well, we've taken a look then at a few companies that you can, get that exposure to the Chinese market through that are listed in South Africa. But this in a scenario where there's a debate raging on whether we should be increasing our offshore exposure, as South African investors, especially when looking at a market like the US, you've got valuations sitting pretty low. Those S&P 500 companies coming out with earnings, and 85% of those earnings having beat earnings expectations so far. So let's look at that kind of exposure where you're looking more so for exposure to global brands, the likes of a Johnson & Johnson, a Caterpillar as well. What's the investment merit as you see it on that side?
Whenever I try to answer that question, I try to come up with a longer term view. And if we go back 10 years, you go back to, let's say, 2000, 2001, our own market traded at a price earnings multiple of about 10 to 12 times. At that stage, the US market traded at a multiple of 45, 47 times. So you can see that their market was 4 times more expensive than our own market. If you look at the valuations now, on a forward basis, we're probably trading at a multiple of about 11 times, the US market trading at a multiple of about 13 times. So that huge valuation gap that we've seen 10 years ago no longer exists. So it's very tough to get the pinpoint switch right, but all I can say is on a 10-year view that it would make sense for South African investors to utilize the opportunity to invest offshore when you can buy true world-class companies at more or less a similar rating to your own market. So from that perspective, we would join the consensus view by saying it is not a bad time to diversify offshore, and if you can get those assets at more or less the same price as our own, I think it will reward investors over the longer term. Having said that, though, I don't think we must disregard the macro risks that are playing itself out at the moment. I mean, it's the debt problems in the US, or the fiscal problems in the US, and of course we've got exactly the same problems in Europe. So it's not, if you diversify, you don't diversify into a world that is problemless, if there is such a word. So just bear that in mind. Of course, the currency, to my mind, is an issue that one should take into consideration. Many fund managers will say, well, you can hedge the impact of the currency out. But again, if I can take you back to the 2000, 2001 era compared to the era where we are now, in those days, the currency traded at about 11 or 12 to the dollar. Now we're trading at below 7 Rand to the dollar. So again, from a currency perspective, I think it is also an opportune time to move money offshore. And that's interesting if you look at institutional investors. Institutional investors have used that opportunity, and many of them already have their 25% exposure offshore in those institutional portfolios.
Alwyn, we're going to have to leave it there for today. Thanks so much for your insights. Of course, Alwyn van der Merwe, Director of Investments at Sanlam Private Investments. And